Did you know the average American tax refund in 2024 was over $3,000? For many people, that refund feels like a financial win, a reward for surviving another tax season. But when you zoom out, a large refund actually tells a different story. It means you overpaid your taxes throughout the year and let the government hold on to your money for free. That $3,000 could have been earning interest, paying off high interest debt, or strengthening your emergency fund month by month. The good news is that overpaying the IRS is rarely unavoidable. With a better understanding of how the system works and a few intentional adjustments, you can keep more of your paycheck during the year instead of waiting for it to be returned later. Make sure to watch until the end to see all the ways the average American is overpaying on their taxes and how you can put more money in your pocket at the end of the year. Why a big tax refund is quietly costing you. A tax refund isn't extra money, it's delayed money. When you receive a $3,000 refund, it usually means you overpaid by about $250 every single month. That might not feel noticeable on each paycheck, but over time it adds up. If that same $250 had been invested monthly in a simple index fund earning an average return, you could easily end the year with hundreds of dollars more than the refund itself. Instead, that growth opportunity disappears. Another way to look at it: imagine lending a friend $3,000 in January and getting it back months later with no interest. You didn't lose money outright, but you didn't gain anything either. That's exactly what excessive tax withholding does. How tax overpayments usually happen. Most people don't overpay taxes intentionally. It usually comes down to a few common patterns. 1. W-4 forms that never get updated. Many people fill out a W-4 once when they start a job and never revisit it. Others intentionally choose conservative settings because they're afraid of owing money at tax time. The result is often maximum withholding and guaranteed overpayment. So if you haven't revisited your W-4 forms in a few years with your employer, take time to revisit that again to see if you can save money on your taxes, especially if you had many life changes during this time. 2. Life changes without tax adjustments. Major life events change your tax situation. Getting married, having a child, buying a home, taking on a second job. When withholding doesn't reflect these changes, you're almost guaranteed to overpay. 3. Missed deductions and credits. Tax laws are complex, and many deductions and credits aren't obvious. If you don't actively look for them, it's easy to miss benefits you're legally entitled to, especially if your situation changes from year to year. Lowering your taxable income the smart way. One of the most effective ways to reduce how much tax you owe is to reduce the income that gets taxed in the first place. There are two key ways that the average American can lower their taxable income in a legitimate way. 1. Retirement contributions. Retirement accounts are powerful because they reduce taxable income immediately. For 2025, you can deduct up to $23,500 in contributions to your 401k. If you're older than 50 years old, that's $31,000. In addition to that, you can deduct up to $7,500 in a traditional IRA, or $8,500 if over 50 years old. Every dollar contributed lowers taxable income dollar for dollar, which can translate into thousands in tax savings depending on your bracket. Do not forget to max out your 401k every year. These dollars go so much farther than if you took your after-tax dollars and invested that through time. 2. Health savings accounts. Health savings accounts are often underused, but they offer one of the strongest tax advantages available. They allow tax-deductible contributions, tax-free investment growth, and tax-free withdrawals for qualified medical expenses. For 2025, the limits are $4,300 for individuals and $8,550 for families. Used correctly, an HSA can function as both a healthcare fund and a long-term investment vehicle. For those that are eligible for HSA contributions, you should definitely maximize your HSA since these are triple tax advantaged. Standard deduction versus itemizing, why it matters. The standard deduction simplifies filing for many people, but it isn't always the best option. For 2025, individuals filing as a single could deduct up to $14,900. For married couples filing jointly, that's $29,800. Itemizing may save you more if you have sizable mortgage interest, state and local taxes, up to $10,000, charitable contributions, medical expenses above 7.5% of adjusted growth income, Homeowners, especially in higher cost areas, often benefit from itemizing. The key is to compare both options every year instead of assuming last year's choice still applies. Definitely seek assistance from a tax professional to understand which method is best. For most people, that is itemized deductions. Deductions for self employed and side hustles. If you earn income outside a traditional W 2 job, the tax code gives you additional opportunities to reduce your bill. Common deductible expenses include 1. Home office space used exclusively for work. 2. Business mileage, 67 cents per mile. What this means is if you use your personal vehicle for legitimate business purposes, you can deduct 67 cents for every business mile you drive. 3. Software, subscriptions, and tools. 4. Professional education and equipment. On top of that, many self-employed individuals qualify for the Qualified Business Income Deduction, which can reduce taxable business income by up to 20%. This deduction alone can dramatically lower taxes for freelancers and small business owners. Energy and home improvement tax credits. Energy efficient upgrades aren't just good for your home, they can significantly reduce your taxes. Here are 3 eligible improvements you may qualify for if you have a home. 1. 30% credits for solar panels, geothermal systems, and solar water heaters. 2. 30% credits up to $1,200 per year for windows, doors, and HVAC upgrades. 3. Higher limits for heat pumps up to $2,000. These credits reduce your tax bill directly and can offset a meaningful portion of upgrade costs while lowering long-term energy expenses. Why tax credits are especially valuable. Tax credits are often more powerful than deductions because they reduce your tax bill dollar for dollar. There are tax credits that apply to nearly every person that's watching here, so pay attention. 1. Education credits. If you're a student, you can claim the American Opportunity Credit, which is up to $2,500 per eligible student. If you have a modified adjusted growth income of less than $80,000 as a single person or $160,000 as a married couple, you can also claim a lifetime learning credit of up to $2,000 per return. 2. 529 education plans. Although federal contributions aren't deductible, earnings grow tax-free and withdrawals for education expenses are untaxed. Many states also offer deductions or credits for contributions, creating immediate tax benefits. Take a moment right now to write down whether your state offers a tax-advantaged 520 education plan. If it does, you might be eligible for some free money that can grow in a tax-advantaged account. The money can be used directly towards educational expenses like books and tuition. Fixing withholding so you keep more cash flow. Remember what I said about you giving the government an interest-free loan? You can fix this by simply fixing the withholdings in each of your paychecks so you keep more cash flow. The ultimate goal is simple. Stop overpaying during the year. The redesigned W-4 focuses on accuracy rather than allowances. Using the withholding estimator from the Internal Revenue Service can help you dial in the right amount. Ideally, you want to break even at tax time or owe a small, manageable amount. That means your money stays with you instead of sitting idle. While I will not go into the details of how to do this in this video, given the differences that every employee will have, I encourage you to plan a conversation with your finance and benefits representative at your company to discuss how you can achieve this so you're not overpaying your taxes on every paycheck. Advanced strategies that can save serious money. 1. Tax loss harvesting. Have a stock investment that didn't go your way? Selling investments at a loss can offset gains and reduce ordinary income by up to $3,000 per year, with additional losses carried forward. Sometimes it might just be best to let go of your loss earlier. 2. Charitable giving with intention. Donating appreciated stock allows you to deduct full market value while avoiding capital gains taxes. Bunching donations into a single year can also help you itemize strategically. One way some of my rich friends have utilized this method was to donate it to the local school that their children were attending. That way their kids and local school district were benefiting. 3. Income shifting for business owners. Paying family members for legitimate work can move income into lower tax brackets while reducing business profits subject to tax. I have met parents that hired their kids to work at their shop on the weekends and paid them their allowance out of their business to reduce the taxable income. This helped them save thousands of dollars through time. 4. Tax-exempt investments. Municipal bonds offer income that's exempt from federal taxes and sometimes state taxes, making them attractive for higher earners seeking stability and tax efficiency. So let's take control of your tax strategy. Overpaying taxes isn't about playing it safe. It's about leaving opportunities unused. By adjusting withholding, maximizing deductions, using credits intentionally, and planning ahead instead of reacting, you can keep more of what you earn and put it toward financial goals that actually matter to you. The best time to fix this was last year. The second best time is right now. I encourage you to rewatch parts of this video and pause it to reflect on how you could save on your 2025 and 2026 taxes moving forward. Stop giving the IRS more than you legally owe and start letting your money work for you instead.